Joining me now is the Lonski Group founder and president, John Lonski. John, great to see you. Thanks so much for joining us this weekend. And I want to get your take on the earnings period because of the 45-plus companies that have reported, all of them have exceeded expectations with the exception of Costco, IBM, and Netflix. The average surprise on the upside, 16%. That's a big number.
Yes, we're getting better than expected earnings in large part because of better than expected revenues. I'm really struck by the fact that of the S&P 500's 11 major corporate groups, 8 of those groups are coming in with earnings growth in excess of 6%. Then that tells me revenues are outperforming the U.S. economy.
Yeah, and you've got consensus expectations for the S&P 500 revenue and earnings growth of 13% and 24%. Revenue up 13% and earnings up 24% for the second quarter is, again, another strong three-month period after we saw similar results in the first quarter.
It's really great news. I mean, the only problem with very strong revenue growth is that it brings into play the possibility that perhaps inflation is still too high to the Fed's taste.
Yeah, and that is why we want to focus on what the Fed does next. Now, John, you're not expecting a rate hike anytime soon, are you?
I am not. I think the Fed is going to keep monetary policy steady moving forward. To the degree that inflation picks up because of higher energy prices, I think the Fed will stand pat. The Fed would only respond to increases by price inflation that are demand-driven, driven by spending, consumer spending, business spending. I don't think that's going to happen. The Fed is going to discount increases in prices that are supply-driven because of costlier energy.
Yeah, but, the chairman also mentioned AI, talking about this AI revolution as one of the most important CapEx spending exercises that we've seen. Do you think that this spending in AI is inflationary?
No, I do not. No, if you go ahead and you look at the totals for data center construction spending and you compare that to overall construction spending, it's still a very small percentage. We might have $80 billion to $100 billion of data center construction spending, but total construction spending is $2.2 trillion. I think there's more than enough room for the U.S. economy to accommodate an increase in spending on AI, an increase in spending on people that are going to be hired to work at developing AI programs and the like. I don't think by itself that represents an inflation risk.
Well, this market is certainly waiting for a return on investment, so these hundreds of billions of dollars being deployed into the AI data center story, John, and I wonder what your thought is about that. Semiconductor stocks, of course, had an incredible couple of years, but we're seeing them roll over in the last couple of sessions. Would you put money to work, new money to work, in semiconductors or any of these other companies tied to AI?
Well, they've had quite a run. You may have, just stated that semiconductor stocks have had a rough week or so, but still, they are up by 50, 75% for the year to date. I mean, that would still prompt me to be cautious as far as putting money into semiconductor stocks. I'm of a conservative bent. Maybe I'd like to see those share prices drop lower before I went ahead and bought semiconductor stock shares. You want to proceed with, but the future for AI is very, very bright. Unfortunately, for companies, that's going to invite more competition. That would put pressure on margins, and it might well be that some of the returns that we expect to see from AI on a company-by-company basis come in lower than anticipated.
Well, maybe then you will get an opportunity to buy these stocks at lower prices. We will see. John, great to talk with you as always. Thanks for being here this weekend.
Thank you, Maria.
Thank you. John Lonski joining us.